Hello everyone and welcome back to the channel. This is Fair Value Finder and today we are taking a look at Garmin Ltd, ticker GRMN. This looks like a really good company. Coming up with a fair value of 116, currently trading for 147, so clearly elevated. Earnings yield a little low, definitely due to the fact that the current valuation is slightly elevated. Cash flow yield looks very good, above their average. Their average is around 17.6, and this last year they came in at 22.6. Dividend yield yielding about 0.5% lower than the typical, again showing that it is a little elevated at the moment. Payout ratio right around where we like it, 43.32%, so they have some room to grow that, although they have been slowing down their growth recently. ROE, ROI, and ROA look very good. Incredible double-digit growth. Even the lowest of them is essentially twice the return that you would expect from the market. Debt to equity looks really good at a 0.23, so clearly they have a strong balance sheet. Margins are high, higher than we look for. Gross was down a little bit, but the net was up. So clearly they've gotten better at their operations. And these margins are incredible, just shy of 60 for the gross and in the low 20s for the net. Now, growth hasn't been stellar for the last 2 years, compound annual growth rate of 1.6%, but analysts are expecting it to pick up into the 9% range, 9.6, 9.3 for the next 2 years respectively. So we'll go in line with that 9.4 for the thesis here. Cash flows have been growing very well. So we're going to take cash flow growth essentially in line with revenue growth because that'll hold them at that 22.5 cash flow yield. I mean, we could knock that down, put them more in line with what we've seen on average. That might be something more in line with a 7.5% instead of a 9.3. Still slightly elevated. 5 would be a bit more in line, but this is knocking our returns down now to the point where looking at 5% growth on average. After you factor in dividends, we're talking 7%. So in line with markets. Assets, they're constantly growing, slowed down a bit more recently. Kind of went with a midpoint here of 4%. It could be lower. Liabilities, they have been decreasing, growing very slow over the last 3 years, decreasing over the last 2. So we hope that they continue that trend with a decrease. Dividend, they only rose 2.5% this last raise. So hopefully they at least do that going forward. I mean, anything less than 2, you're not even beating inflation. And then margins, again, their margins are elevated over their typical. So if they bring it back down in line over the course of the next 5 years, that'd be losing about 1.8% per year. And if you buy at today's price with all of that factored in, a fair value of 114, that fair value grows to 141 over the course of the next 3 years. So you're sitting on $3 in gains, about 2%, and dividends are factored into that. So you're actually losing $6 in fair value and getting it all back in dividends plus an extra 2%. Now, over the next 5 years, you're looking at growth in the fair value to outpace the current share price by $9. So you're sitting on a profit of 24.65 per share or 17%. So I definitely don't like the price that's currently trading at. I feel like it's really elevated. 115, 120 would be much more reasonable. At that point, you're outperforming in the 3 and the 5 year. It's been as low as 95 this year. So that's not too much to ask for. And that's even slightly above the fair value that we came up with. I mean, this stock has been all over the place historically. In 2020, it was trading in the mid 90s, and then 2021, 140. 2022 back down in the low hundreds, and 2023 essentially the same, and now it's back up to 130s. So looks a little cyclical. I mean, looking at all that with the technicals, I'm not surprised it's going high 140s, 150s. But fundamentally, I think the lower to mid hundreds are definitely fair. 120, you'd be about right in line with markets plus or minus a percent per year. But it all comes down to the thesis. We have some levers that we can pull here. I don't think that they're going to really buy back more shares, especially at elevated prices. Cash flows, I think that they could come in a little bit higher. We did bring them down. I mean, if they can hold what they currently have, you're looking at a whole lot better of a situation. We'll just say 9% growth, 22.2 down 0.4% from where they currently stand. And all of a sudden you're looking at returns with dividends factored in 8% per year. And now we can raise up that price to be in line with the markets, more in line with 125. Let's say they can hold these margins where they're at instead of shrinking the margins. Well, that boosted 0.7% in annual average returns, almost 9% with dividends factored in. And now you're right in line with the 3-year and outperforming in the 5-year time frame. So this is definitely a stock that I'm interested in. I think most scenarios are giving me returns in line with markets. 8 to 10% is what we really like to look for. Better than that is ideal. But I'm just trying to find a red flag with the company, and I'm not really seeing it. Reasonable dividend at a decent payout ratio, really good returns, balance sheet's healthy, cash flow yield is high, margins gross and net are high. There's not really a red flag here. So I wouldn't really mind paying a bit more of a premium on something like this, go more towards the 130, 135 range. So this is definitely going on the watch list. I'm interested in it for sure. And if it pulls back, we might be seeing it make an appearance on the monthly stocks that I'm buying. So I want to thank you guys for watching. Please like if you enjoyed the video, comment what other stocks to take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.